Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good afternoon, good evening, good morning, and welcome to Technical Analysis Explained. I am your host, Tom Schneider, CMT with NinjaTrader. And on Technical Analysis Explained, we like to delve deep into one topic, one indicator, one set of ideas, or just one topic that pertains to technical analysis. It might be something that my partners Jim Cagnina and Mike Burke might talk about on the show, or something that one of our guests talks about on the show. And we do a little bit of a deeper dive so that you, the viewer, can understand a little bit more about that tool, that set of ideas, and you can apply them to your trading if you choose. If you don't choose, that's fine too. I do want to reiterate that past performance is not indicative of future results. And so when we talk about concepts and theories and technical analysis, always keep that in the back of your mind, that nothing's 100%, that even though we say this is what could happen, sometimes it doesn't. So just keep that on tap. So today's topic is candlestick patterns. And candlestick patterns, it's the chart, the candlestick chart is my chart of choice because it provides a little more information than a regular bar chart. So let's go to the bar chart and see what a bar chart gives us as a trader. I'm looking at a E-mini S&P 500 futures chart, December contract. It's a daily chart. And you can see here, these are considered, some people call them OHLC charts. I like to call them bar charts. But what they are, each bar represents 1 day's worth of trading. And there are 4 points that create this bar, each bar. And those 4 points are the open, the high, the low, and the close. So that's interesting, right? I can kind of guess that maybe this is the open because it's on the left side of the bar. And on charts, we view time as something that progresses from the left to the right. So something that opens the day would happen first, which would be that little bar part that happens on the left. And the close would be the last print of the day, and that happens on the right. It's pointing towards the next bar. So that's interesting. There's the concept of some sort of time there, but I think candlesticks give us a better clue. So let's take a quick look. I'm just going to switch to a different tab, but you could always go up here you wanted to switch. Well, let's do that here. Let's see if that looks any better. Here's a candlestick chart. So quickly, we just took all of that data that was bar data and turned it into candlestick charts. Now, the default is red and green. The red candles represent when the close is lower than the open. We consider that a bearish candle. So I can look at pretty much any candle. When I see a big red candle, I know that the market started at the top of that candle or near the top of that candle and finished at the bottom of that candle. Likewise, a green candle would be where we have the open of the candle at the bottom and the close near the top. It could be at the top, it could be near the top. Right away, I can see the direction of the day's trading. In this case, because it's a daily chart, I say days trading. But if you had a weekly chart up, it would be the week's trading. Or you could even use these, of course, in intraday candles. So if I had a 10-minute chart up, that would be each candle would represent 10 minutes worth of trading activity. So why do I like this better than bar charts? Well, I don't have to do that interpretation, that quick comparison or the comparison of the open and the close, that little tab that was on the bar, on the stem, if you will. These candlesticks do that for me. So the body of the candle, let's talk about some terminology before we go into the patterns. The body of the candle is the distance from the open to the close. And I did that backwards, the open up here to the close down here, or the open down here and the close up here, in the case where it's positive, a bullish trend or a bullish candle. Above and below that, we may have something called wicks. Some people call them stems. Some people call them the sticks themselves, but what they are is the connection of the body to the high or the low of the day. So when I look at a candlestick chart, I know where the high is and I know where the low is, especially if the body of the candle is somewhere in between. If it's in the middle, even if it's to the low side or the high side, and I can see those wicks, I know right away where those highs and lows are. It might be a little more confusing when you have a day where we opened at the low or we closed at the high, or vice versa, where there are no wicks. Well, that just means that the open or the close is equal to the high or the low. So one bar can tell me a lot in candlestick charting. We already mentioned the bullish and the bearish days, if you will. Big bullish move up, very green body, very bullish candle. A big red body candle means the market moved down. That's bearish. I can see it right away. But there are other interpretations too, where the market didn't behave as directional. And the first thing I think of is a doji. Now I'm going to come over here to the right, kind of blow this up a little bit, because we can see what looks like to be a doji right here. And this just happened 3 days ago. This happened on 4 days ago. This happened on Monday. This is where the open is equal to the close. That is the doji. Now, it doesn't have to be exactly equal. It can be within a few ticks or even a few pips or handles or index points, whatever you want to call it, depending on how big the index is. If I'm looking at the Dow Jones or the NASDAQ, where my scale is in the 15,000, 35,000 range, then it might be more than just a couple. It might be 10. But when you look at it on a chart, it basically tells me that we closed at the open. Now, why is that important? Well, it means nobody was really in control. When we talk about nobody, I'm talking about buyers and sellers. This is all about demand, supply and demand. This is all about who's in control. Where are the buyers coming in to push the market up? Where are the sellers coming in to push the market down? When we see a doji, we know that there was no advancement for the buyers nor the sellers at the end of the bar. So it's somewhat of a neutral day, I will call it. And that doji can happen in an uptrend. It can happen in the downtrend. It can happen in a consolidating phase. You might call this a doji right here, even though we can see a little bit of a green body. It might be close enough that some algorithms will pick it up as a doji. But look, it's in the middle of a consolidation phase. So that's a little bit different in terms of the trend when we're in an uptrend, but it should be treated the same, a little bit of indecision. So that is a doji. Now, there are different types of dojis. Let's see if we can find them. And it might be hard to find. Some of these patterns are more prevalent than others. When we have a doji where we're going to use this example as close as we can right here. This is probably the best example I can see. And I'm going to pull this down, try to highlight it a little better for you. When I distort everything, though, it kind of doesn't look like a doji, but we're going to say that this is a doji. And not only is it a doji, it is a gravestone doji, which tends to be bearish. Well, why is that bearish? That's bearish because the buyers brought this market all the way up here. In this day, it traded all the way up here and sellers knocked it back down. So that's not bullish. That's not the bulls being in control. When we think doji, we think, well, sellers nor buyers advanced nor retreated. But you also have to look at the wicks. You might say, yeah, neither one advanced or retreated, but the sellers had the upper hand. They knocked this market down to bring it back to a doji. So they were a little more powerful. Buyers didn't really bring it up that much, but they did end the day somewhat in the same position. So it's kind of a tricky thing to interpret these things, these candlestick patterns. Now here's a doji. Let's call this a doji as well. And this is what might be called a long-legged doji. It's kind of really indecisive. There's a big wick on top, there's a big wick on bottom, and there's almost no net change from open to close. Yeah, there's a little bit, but it's close enough, as we say, for government work. So what does this mean? It's kind of a neutral day. Again, indecisive. Market didn't really advance much, didn't decline much. It did during the day. Sellers knocked it down. It came down here, buyers pushed it up. So when you see this doji hash mark kind of in the middle, where it doesn't have to be perfectly even wicks on either side, but it shows direction rejected, direction other way rejected, no real advancement. It's kind of an indecisive day. There is another doji which might be harder to find. That's called a dragonfly doji. And you can imagine, just like we have a gravestone doji, which is the open and closer at the bottom, the dragonfly doji, that open and close are at the top. Now you might look at this and say, that's close. That to me is a little too much of a body there. We can see that when it's not so scrunched up. That might be close to, yeah, but it's not really at the top. So sometimes these patterns are not easy to find. So let's move on. Those are one bar patterns. What I really like about the candlesticks too, just like a bar chart has indicates some sort of time, it's really easy to see and imagine how the market progressed during the day, generally speaking. So when I look at a big bullish candle, I imagine that this market was pretty much trending up all day. Now, there might have been some pullbacks and then resumption of trend, and that's fine. I'm not going to say it was a straight path. But I can pretty much say that at the beginning of the day, we did a lot of trading down here. We did some trading up here at the end of the day, and you know, there was volume in between. Just like here. We probably traded up before we traded down. We might have traded up, down before we traded up, but generally when you open, the nearest point is where you kind of, I look at it, you make that first. The market's pushed up, but then sellers take control and they hammer this down. Buyers come back and bring it down here. It's kind of like the path of least resistance. Now, we may look at a day, this day, and look at an intraday chart if we really want to see the true path. But I can kind of get a sense of what happened during this day. Look at this next bar, or this next candle, I should say. We opened here, market most likely traded down, and then turned around at some point, made the high, and eventually finished here. Again, not perfect straight paths for these, but that's the general trend of the candle. So I like candles because I can get a sense of not only what the 4 points are that are important, open, high, low, close for this day, but I get a sense of how that day might have unfurled as it was trading intraday. So that's what I like about the candles. Now let's move on. Those are kind of my thoughts on one bar patterns. Let's take a look at some 2 bar patterns. And You know what? Instead of just looking back and trying to find them with our eyes, I'm going to enlist the help of a tool that we have on the NinjaTrader platform. If I right click and go to indicators, we actually have a pattern, an indicator that helps us recognize patterns called Candlestick pattern. And if I click and hit add, a couple things I want to do before I put it out there, which is, first of all, I'm going to update it on each tick. That's just like what I like to do that for my studies. I get rid of the label. And then the other thing is, what pattern are we looking for? So if I go to this drop down, you can see a bunch of patterns here. I don't know. There looks like there's about 30-ish patterns, maybe 28, maybe 32, but somewhere along those lines of a bunch of patterns. I could be off in my counting. Maybe it's only 28, but you can see here's doji. We just talked about doji. And if I hit apply, it tells me for the amount of data I have on this chart, there are 12 doji patterns found, and it seeks them out and it labels them. So here you have doji number 12, doji number 11, doji number 10. What I love about the labeling is, as best as it can, it puts that labeling where it makes sense to. And what I mean by that, in an uptrend, it puts the label on top. In a downtrend, it puts the label on the bottom. Not to suggest that this is a bullish indication. It could be part of a bullish or bearish pattern in this case. But it's just one of those things that makes it easier to read and think, okay, well, here's a doji, big move, big wick on the bottom, not so big wick on the top, finish the same, little bit of indecision, but this is buying pressure. Maybe it is bullish. But sometimes these dojis at the end of a trend indicate a stall. If I look at this and I say, okay, uptrend for the last 7 or 8 bars, and then we get a doji, that's pretty interesting thing to say. This might be stopping the trend, at least for the next bar. And I can pull this back and I can see where the other dojis are. Here's a doji right there. There's a doji right there. We'd call that a long-legged doji. Here's a doji. You call that a long-legged doji. I don't know if that has a label. That just might be a doji. But you'll notice that these dojis aren't exactly the same open, high, and closed. In fact, it'd be really rare to find that. So that's why we allow for a couple of points here and there. Let's look at the bar. The bar here, the open is at 44.66 and 50, and the close is at 44.67.75. So it's a whole $1.25 higher than the open. So it's slightly bullish, but ever so slightly. It's to be almost non-existent. So that's one thing we can do with this indicator. Well, I started to talk about 2-bar indicators. So let's go back to our indicator. And let's find a 2-bar indicator that I like to look at. With candlesticks, generally, for every bullish pattern, there is a bearish pattern, a complementary bearish pattern. It's almost like if you flip the chart over, you'd be looking at the opposite direction pattern. I'm going to look at the bullish engulfing. We'll hit apply, and it tells me 4 bullish engulfing patterns are found. Let's take a look at which ones we found on this chart. Now, there are more back here. I've got a lot more you can see on the left. But we'll just focus on these. Bullish engulfing regards the bodies, okay, the body of the candle, and compares it to the previous candle's body. And if the previous the candle's body fits within that the current candle's body, it's considered engulfing. This candle, we have a lower low and a lower open or close and a higher open or close. And why do I say or? Well, most likely it's going to be open at the bottom and close at the top when we see this at the bottom of a downtrend. Here, not always the case. Here we are near the top of the market. Markets come down a little bit. We have that same thing going on. This market closes here, right here, and we can see that close is lower than the open. And this open is either equal to or less than this close right here. And we can see right away that this close is higher than this open. Now, how do I know it's open and close? When we mark the chart, we actually mark the coloring. So it kind of gets obscured, and I can go here and I can do the comparisons. But I know, because this is bullish engulfing, this would be a green candle. So that I know that this is the close up here, this is the open. What does that indicate? Maybe some follow through on the next bar. That's it. As a trader, that's interesting to me. If I get a bullish engulfing on the daily chart, that might influence my decision tomorrow going into trading. Same thing here. If I think that, well, this is a bullish engulfing, I should expect some follow through. Now you could see here that this open was well below this close. So in that hour between when it was open and closed, and it might be a weekend too, I have to check. Let's see. Let me bring up my crosshair. Yeah, this was an entire weekend, I believe. No, this was the next day. Never mind. And so in that hour, it pulled back a little bit, but it did follow through on the bullish side. So these bullish engulfing candles can indicate possibly what the trend is the next bar. If I go back even further, we can pick out those other two, and we can see what they look like. This one came not quite at the bottom of the downtrend, but in an uptrend. This one came kind of in a consolidation mode, and it continued. It basically elevated this market. It continued a little bit higher, but not much. It went into consolidation mode and waited 2 months before it went higher. But these indications don't give us a projection of how long that indication will last. Look at this. We have a bullish engulfing here. We traded up here and then turned right around. So I would use these as indications maybe of the next bar. That's the bullish engulfing. As you can imagine, if I go to the indicator, we'll have a bearish engulfing. And it's 6 bearish engulfings. That's a really nice one right there. You can see it. This bar engulfs this body, engulfs this body, and then kind of turned around that direction. Whether you think it's sideways, slightly up, it did turn that around in this case. You can see it doesn't always turn it around for good. We have a bearish engulfing here. It kind of stayed down here, but not quite. It actually it continued an uptrend the next day after that. So take it for what it's worth. These are only indications, and they're not always 100%. With that, I do want to take a look at a couple other indications. We've called something called a piercing line and dark cloud cover that I like to look at. And we'll see if we find them. Some of these indications don't always appear. Let's take a look at dark cloud cover. That's a bearish reversal pattern. Let's see. We found 0 dark cloud cover. So let's see if we find the opposite. And I didn't really look for examples. I didn't want to cherry pick. I didn't want to see where we could find something that looks perfect, right? That's not what we're about. Here's the piercing line. Nope, not on this one. So basically what the dark cloud cover is, and this is about, it's kind of like the opposite of a bearish engulfing or a bullish engulfing. Imagine if this candle right here only got halfway or just past halfway of the previous candle. So it wasn't as bearish here, but it did turn around the market. We went from a bullish market, a green, nice, strong green candle here, and we turned around and we made a red candle, but it didn't quite get to the open of the previous candle. It didn't get to the bottom of this, but it got through half of it. That's called a dark cloud cover. On the bottom, it would be like something like this. And I'm surprised it didn't pick this up. There might be something in the calculation that it just quite didn't get, but this is the closest to a piercing line. We have a down direction and then a reversal, and that might indicate, and I say a reversal bar, it's the opposite colored bar, and it gets halfway up and might indicate a reversal, which it did here. Now, there might be something in the calculation that this missed just by, a tick or two, but that's what this indicates. So dark cloud cover and piercing lines. I do want to go over one other indication, and it's really a type of indication, but it's a 3-bar pattern. So if I go back to my indicators and we go to the drop down, you'll see we have these stars. One's called an evening star. Let's take a look at what that does. We have 6 evening star patterns. This is great. I talk about this on my show with Jim and Mike Burke on the bookend shows. We talk about looking for a 3-bar reversal pattern. When we have a bullish bar like we did here, this was a green bar, and then we have a small body candle. It doesn't have to be a doji, but a small body candle, and then a reversal. This is a red candle, and it turns it around. Now, it doesn't have to exceed this body. It can get close, but that is a nice little reversal pattern that can pan out. Sometimes it doesn't. Look at this. We have a bullish candle, nice little body candle here, almost a doji. And then we had this reversal that, wow, it almost went twice as far as this candle, if we look at that. But the market turned around. So that's why we say nothing's 100%. Past performance doesn't mean that the next time we see that, it will happen the way we want to. Now, something that I think is interesting about this calculation, some evening stars are caught, and I wouldn't agree with them. I wouldn't agree that this is an evening star. First of all, that body is a little too big for me, and I'd want to see more of an extension. This is not a really great reversal candle right here. Here's a nice start to it. Here's a second point to it. But this doesn't get, this wouldn't even be considered dark cloud cover if we moved it over. So I don't think that's a great evening star. The thing about candlestick patterns, not always the easiest to program. So take that with a grain of salt. Again, over here, big bullish candle, small body candle. Okay, I'm liking that. That's okay. But then we don't have follow through the next day. Yes, we have a big wick on the bottom, but buyers came in, pushed it back up. Now, it did happen to continue, so that was fortunate if you decided that this was a time to go short or get out of your long. But as a reversal, I wouldn't be too happy with that, seeing that. So, the thing about programming formulas, they don't always work the way you want, but they can alert you to something that might be happening. Let's take a look at the candle. I just did want to show you something. I'm going to turn off that indicator, but it's good to have on there. And you could put multiple instances of this indicator up and say, you know what, I want to look for evening star and morning star. You could put up a second instance. Let's take a look at that morning star. It's basically the same pattern on the bottom, right? Remember how I said when there's a bearish indicator, there's probably a complementary bullish indicator. Here's the morning star that's complementary to the evening star. Got a big bearish candle here, a candle that says hold up now. We had some advancement in that direction, but buyers came on and said, wait a minute, we don't want to advance in this direction anymore. So a small body candle, and then the buyers followed through the next day and almost got it to the top of this body. That's okay. I like that as a reversal candle, and we can see that it did continue to trend up. Not always the case, but that's the only one that we saw on this chart. One thing I do want to show you with candlestick charts, though, is there is the possibility that you might not be able to distinguish between the red and the green. You might have some colorblind situation going on, and that's fine. What I like to do then is we can go into data series, And you can change the color for up and down bars. Now, here we have lime green for up bars. You can make them transparent. And for down bars, you can make them really whatever dark color you want. I like black. And now I hit OK, and you can see that the black candles are bearish and the white candles are bullish. And that traditionally has been thought of, or explained to me anyway. Think of it, and these candles as empty. Think of them as a helium balloon. You know, this is filled with gas, and they're rising. The black candles are descending. So that's one way you can change your charts. If you do have some sort of difficulty seeing colors, you can change them to black and white. Make the positive candles, the up candles, hollow or transparent, and it looks really nice with a white background, I think. And you can still apply that study, that candlestick pattern study, and find the patterns. Now, if you want to explore, you can use that indicator to explore all the other patterns. I mean, there's so many. Just remember that some of these are opposites to other studies. Some are easy to see, bearish engulfing and bullish engulfing. They're probably complementary. But you would have to know that a dark cloud cover is complementary to piercing line. There's nothing in those names that say one's the opposite of the other, but that's just part of the thing about studying about candlesticks. Steve Nissan brought this I should say in a widespread manner, brought this to the States and to Europe in the 90s. He published a couple of books and really made them popular back 30 plus years ago. And these books are great. They explain all of these patterns and what's behind them. These patterns have, they're kind of trying to replicate the mindset of the traders or what's happening in the market when you see these patterns. So it's interesting. You could probably look them up online and you could see what these mean and get a faithful representation or explanation. But you can always go to the source, and Steve Nissan's books are really, really keen. So look for those. So candlestick charting, I think some of the benefits are, one, you can quickly see whether a candle is bearish or bullish. You can quickly see if a trend is made up of mostly bullish or bearish candles, or is there some indecisiveness in between? And then with the patterns, you can identify areas where there might be stalls or reversals in the market and use those accordingly. For the most part, I can't think of an instance where using candlestick patterns are going to help you with targeting a price level. Aside from using this type of chart with standard technical pattern recognition. Candlestick patterns are mostly about bias, what the direction is, and where it might change. But it doesn't really help you with targeting, okay, I think it's going to change and it should go to this level. No, candlestick patterns don't help you with that. But as a trader, I want to know if the market, if the chart is thinking that we're going to keep on going in this trend, is it going to stall or could it reverse? That can help me with my intraday trading. So with that, I want to thank you viewers for coming and watching Technical Analysis Explained. We'll be back in 2 weeks. I'll have a special guest star as well. Calls himself the Pivot King, so maybe you can guess what we'll be talking about. That'll be in 2 weeks. In the meantime, have a great trading day.